Hey, welcome back to Accounting for Managers. Here at UMGC, I am happy to have all of you still with us as we are nearing the completion of the course. We are well into week 7, and I appreciate you taking the time to join me today as we talk about the statement of cash flows, which is what this week is all about. So I prepared a really nice, simple presentation for you that I'd like to go over, and this won't take very long. But if you have any questions along the way, just feel free to unmute your microphone and ask your question, and I'll be happy to answer your questions. So, without further ado, let's go ahead and get started. All right. So, the first thing I want to talk about is the purpose of the statement of cash flows. So the statement of cash flows reports the cash receipts, the cash, which is the cash inflows. That's the cash coming into the business from the sale of inventory, from selling property, plant, and equipment if we had to, from taking out a loan. For all of those reasons, we would have cash coming into the business. Okay. Primarily, of course, the business's objective is to sell our inventory. That's how we generate cash. That's how we generate sales. And so the cash statement of cash flows represents the cash coming into the business and all of the cash going out of the business, the outflows during an accounting period. And cash goes out of the business for various reasons. We're paying our bills, we are paying our employees, we're purchasing property, plant, and equipment, uh, or we're repaying loans, paying interest, etc. So the statement of cash flows represents the cash coming into and out of the business, and it's separated out into three areas. The first is operating activities. That's the day-to-day operations of the business. Investing activities, which is the purchase or sale of property, plant, and equipment. And financing activities, which is taking out a loan, repaying a loan, uh, stocks, bonds, etc. Finance. So the statement of cash flows represents cash coming into and out of the business for operating, investing, and financing activities. That's how it's organized. The details of the sources and uses of cash make the statement useful for our users. The information that the statement helps to answer are questions like, what explains the change in the cash balance? Where does a company spend its cash? How does a company receive its cash? And how does income and cash flows differ? What makes them different? So that's everything that the statement of cash flows helps to answer. That's the overall purpose of the statement of cash flows. So what makes the statement of cash flows so important? Well, of course, it's the information about cash flows in the business that can influence decision making is what makes it so important. Information about cash flows helps users to decide whether the company has enough cash to repay its debt. It helps to evaluate the company's ability to pursue new investment opportunities. And managers use the statement of cash flows information to plan the day-to-day operations of the business and to make long-term investment decisions. So all of these things combined make the statement of cash flow so important and so useful for the business. Cash flows include both cash and cash equivalents. The statement of cash flows explains the difference between the beginning and ending balances of cash and cash equivalents. We continue to use the phrases cash flows and the statement of cash flows, but remember that both phrases refer to cash and cash equivalents. A cash equivalent means that it must satisfy two criteria. The first is that it's readily convertible to a known amount of cash, and two, it's sufficiently close to its maturity so that the market value is unaffected by interest rate changes. So these two things must be true in order for us to be able to convert something into cash. That's what we call cash equivalent. I had mentioned that the statement of cash flows is broken out into three primary sections: operating activities, which is the day-to-day operations of the business; investing activities, which is the purchase or sale of property, plant, and equipment; and financing activities, which are things like taking out a loan, repaying a loan, etc. Since cash and cash equivalents are combined, the statement of cash flows does not report transactions between cash and cash equivalents, such as cash paid to purchase cash equivalents and cash received from selling cash equivalents. However, all of the cash receipts and cash payments are classified and reported on the statement in one of these three categories: operating, investing, or financing activities. Individual cash receipts and payments for each of these three categories is labeled to identify their organizing transactions or events. Net cash inflow occurs from the receipt in a category exceeded the payments, and net cash outflow occurs when payments in a category exceed the receipts. So I'll break this down a little bit more for you in a nice visual representation. When it comes to the operating activities, these include transactions and events that affect net income. Examples are the production and purchase of inventory, the sale of goods and services to customers, and the expenditures to operate the business. Not all items in income, such as unusual gains and losses, are considered to be operating activities. As you can see on this slide, it lists more common types of cash inflows and outflows for operating activities. So when you see operating activities, I want you to think about day-to-day operations of the business. And that's where you're going to find these types of things. The second category is investing activities. Investing activities include transactions and events that come from the purchase and sale of long-term assets like property, plant, and equipment. These also include the purchase and sale of short-term investments in other entities and lending and collecting money for notes receivable. This slide shows us examples of cash flows from our investing activities. Cash from collecting the principal on notes is an investing activity. However, collecting interest on notes is considered an operating activity. If a note results from sales to customers, it's considered an operating activity. And the third area that we have on our statement of cash flows is financing activities. And this includes transactions and events that affect long-term liabilities and equity. Examples are: 1, obtaining cash from issuing debt and repaying debt; and 2, receiving cash from or distributing cash to owners through interest payments or dividends. Borrowing and repaying principal on long-term debt are financing activities. Payments of interest on the loans is an operating activity. So that's just the only distinction that I wanted to make with respect to financing activities is that when we take out a loan or repay a loan, that is a financing activity. However, in relation to that loan or note, the interest part is an operating activity. So just an important distinction to note. So that way, when you're reading through your 10K report and you're looking at the statement of cash flows, you're going to find interest under operating activities, not under financing. So just important to note that. Operating, investing, and financing activities are loosely linked to different parts of the balance sheet. Operating activities are affected by changes in current assets and current liabilities. And of course, from the income statement. Investing activities are affected by changes in long-term assets, like property, plant, and equipment. And financing activities are affected by changes in long-term liabilities and equity. So this slide here represents the linkages between the statement of cash flows and the balance sheet. Exceptions to these linkages include current assets unrelated to operations, like short-term notes receivable from non-customers and from investment securities, which are technically investing activities. And current liabilities unrelated to operations, such as a dividend payable. A dividend payable is a financing activity. So just things to keep in mind. For non-cash investing and financing, some investing and financing activities do not affect cash. One example of this is the purchase of long-term assets using a long-term note or a loan. This transaction involves both investing and financing activities, but does not impact current period cash. Such transactions are reported at the bottom of the statement of cash flows in a note to the financial statement because of their importance and the full disclosure principle. As you can see on this slide, it lists transactions that are commonly disclosed as non-cash investing and financing activities. Examples of such include the retirement of debt by issuing equity stock, a conversion of preferred stock to common stock, leases of assets in long-term lease transactions, the purchase of long-term assets by issuing a loan or a bond, exchange of non-cash assets for other non-cash assets, for example, exchanging a piece of land for a new property, or the purchase of non-cash assets by issuing equity or debt. So these are the types of transactions that you will commonly see that technically do not involve cash, but would be listed as notes to the statement of cash flows for both investing and financing activities. This slide represents the typical format of a statement of cash flows. The statement of cash flows reports cash coming into and out of the business for operating investing, and financing activities. The statement of cash flows shows the net increase or decrease from these activities, and it ties into the cash balance. Any non-cash investing and financing transactions are disclosed in a note or separate schedule. So as you can see in front of us, we can see that the cash coming into the business from sales we've made to our customers minus the cash going out of the business for our day-to-day operating expenses equals our net cash provided by operating activities. And we follow that same principle for investing and financing activities. Cash coming into the business from the sale of property, plant, and equipment, and cash going out of the business for property, plant, and equipment. Cash coming in minus the cash going out equals the net cash flow provided by investing activities. And the same concept applies for financing activities. So cash coming in minus the cash going out equals the net cash flow provided. Then, of course, we can add and subtract these all up to find our net cash increase or decrease in total. And of course, then we can add that to our beginning balance minus the ending balance to find the net cash balance, which is reflected as the cash balance on the balance sheet. So that's how the two are tied together very strong. When it comes to preparing the statement of cash flows, the companies follow these 5 steps. The first thing they do is compute the net increase or decrease in cash. The second thing companies do is compute the net cash from or used by operating activities. So the cash coming into the business minus the cash going out of the business for operating activities. Then we do the same thing for investing activities, and then financing activities. And then we compute the net cash flow from all of these sources, and then we prove that by adding it to the beginning cash balance to get the ending cash balance. That's the overall process that we follow to develop the statement of cash flows. When it comes to analyzing the cash account, we compute the net increase or decrease in the cash is a simple but critical computation. It equals the current period's cash balance minus the prior period's cash balance. This is the bottom line figure for the statement of cash flows and is a check on accuracy. So that's what this slide shows us. The statement of cash flows summarizes and classifies the transactions leading to the increase or decrease in the cash account. Preparing the statement of cash flows requires determining whether an individual cash inflow or outflow is an operating, investing, or financing activity, and then listing each by their respective activities. So here in this example, we can see things like customer receipts from sales, receipts from the sale of assets, receipts from the issuance of stock. We know that the receipts of sale is from operating activities. The receipt of the sale of fixed assets is investing activities. And the receipt of common stock issuance is financing activities. And then on the right side, we have our credits to cash, which represents payments for inventory. That's an operating activity. Payments for operating expenses. Of course, that's operating activities. And the payment of interest, which is also an operating activity. Then we have things like payments for taxes, payments for notes retirement, payments for dividends, financing, and then, of course, investing and then financing activities. So we can see how these things are commonly categorized. There's a couple of methods that companies commonly use in order to prepare the financial statements, especially for this statement of cash flows. And one of those approaches to preparing the statement of cash flows is to analyze the non-cash accounts and draws on double entry bookkeeping. In sum, all of the cash transactions eventually affect non-cash balance sheet accounts. This way we can determine cash inflows and outflows by analyzing changes in non-cash balance sheet accounts. This slide uses the accounting equation to show the relationship between the cash account and the non-cash balance sheet accounts. Cash equals liabilities plus equity minus non-cash assets. That's how we determine the cash balance. It's just another approach to do so. The information that companies use to prepare the statement of cash flows include things like the comparative balance sheets, the current income statement, and any other additional information. Comparative balance sheets are used to compute changes in non-cash accounts from the beginning to the end of the accounting period. The current income statement is used to help compute cash flows from operating activities. And additional information oftentimes includes details that help to explain cash flows and non-cash activities. Companies prepare their statement of cash flows in one or two ways, and these are the two different ways that they're displayed. One is the direct method, and the other is the indirect method. The direct method separately lists operating cash receipts and operating cash payments. The cash payments are then subtracted from the cash receipts. Very simple. That's why we call it the direct method. It's probably the simplest way to do it. But when we see the indirect method, this reports net income and then adjusts it from the items that do not affect cash. This does not report the individual items of cash inflows and outflows from the operating activities. The net cash amount provided by operating activities is identical under both the direct and indirect methods. It is always going to be equal. The difference is with the computation and presentation of the amount. The Financial Accounting Standards Board typically recommends that the direct method be used, but because it's not always required for the indirect method, is arguably easier to compute. Nearly all companies report operating cash flows using the indirect method. Of course, provides a greater level of detail. In looking at the indirect method a little closer, we can get a really good understanding of how the indirect method is computed. So here we see some information to prepare the statement of cash flows that explains the changes in cash as reflected in its cash balance sheet, on the balance sheet. It's computed, of course, using all of this information. The good news is you don't have to do that part. I just wanted to show you what it looks like. The indirect method starts with the accrual-based net income and makes two types of adjustments to arrive at the cash flows from operating activities. Adjustments to the accrual-based net income include adjustments to the income statement, items that do not impact cash, and adjustments for changes in current assets and current liabilities. So that's just the overall process. It's what I want to kind of show you. So that way you have a really good understanding of what it is that you're looking at with respect to the indirect method for the statement of cash flows. Managers need to review cash flows for business decisions. Creditors look at the statement of cash flows to evaluate the company's ability to generate enough cash to repay any of their debts. And investors assess cash flows before buying and selling stock. To effectively answer these types of scenarios, it's important to separately analyze investing, financing, and operating activities. And so that's kind of the examples that we can see here on the right. And analyzing the operating, investing, and financing activities separately, we can get a pretty good idea of what the company's doing. It's also important for us as managers to be able to make quick decisions by making a few computations. One of my favorite ratios is the cash flow on total assets. Cash flow information can help measure the company's ability to meet their obligations, pay dividends, expand operations, and to obtain financing. This cash flow on total assets ratio is such a measure. The ratio measures the actual cash flows and it's not affected by accounting recognition and measurement. It helps to estimate the amount of time of cash flows from operating activities. That's why I like it the most. The way we calculate this is we take our net operating cash flows and we divide by average total assets. And just as a reminder, the way that we find average in accounting is we take the beginning balance plus the ending balance and we divide by 2. It's also helpful for the company as they're generating their statement of cash flows to generate through a spreadsheet. I know it sounds too simple, right? So, in preparing the indirect method spreadsheet to analyze non-cash accounts, it can be quite challenging when a company has a large number of accounts and many operating, investing, and financing transactions. So the spreadsheet is also often called a worksheet or working paper. And it helps us to organize the information needed to prepare the statement of cash flows. Spreadsheet, of course, makes it easy to check the accuracy of our work. Now, this graphic you see on the right side shows the indirect method spreadsheet for a company. We enter both the beginning and ending balance sheet amounts on the spreadsheet. We also enter information on the analysis of changes in columns to explain changes in the accounts and determine the cash flows for operating, investing, and financing activities. Information about non-cash investing and financing activities is reported near the bottom. So this kind of shows you some of the prep work that we go through when it comes to creating our statement of cash flows. We also compute this statement of cash flows from operating activities under the direct method by adjusting accrual-based income statement items to the cash basis. The usual approach is to adjust income statement accounts related to operating activities for changes in their related balance sheet accounts, as we can see on this slide. The framework for reporting cash receipts and cash payments for the operating section of the statement of cash flows under the direct method can also be seen on this slide. So I like this slide for that reason. So revenue or expense plus or minus adjustments for changes related to the balance sheet accounts equals the cash receipts or payments. We also consider it operating cash receipts minus operating cash payments equals the net cash used for operating activities. Remember, the direct method's probably the easiest. The indirect method's the more challenging one. Companies like to use the indirect method because it provides a greater level of detail. So when you're reading through your 10K report for your company and you're examining the statement of cash flows, it's important to make that distinction and keep that in mind. You'll probably end up looking at the indirect method. This slide helps to summarize the common types of adjustments for net income which yield the net cash provided for operating activities under the direct method. So that's my very short and simplified presentation for the statement of cash flows. The next thing that I wanted to talk about very briefly today is for our Unit 7 assignment. With respect to the assignment, I did provide an updated version of the project template. Using this updated version of the template, one of the first tasks you want to complete is computing free cash flow. And the free cash flow formula can be seen here. So we're going to go equals net income plus depreciation expense and amortization expense minus capital expenditures. And that'll give us our free cash flow amount. We also want to enter in our net income amount. That's, of course, going to come from your income statement. The depreciation and amortization amounts are going to come out of your cash flow statements or in the notes to the statement of cash flows. The capital expenditures are your investing activities on the statement of cash flows. And we want to interpret our free cash flow as being either positive or negative. A positive free cash flow indicates the strong financial health of the company. A negative free cash flow might indicate a high level of reinvestment. So it's important for us to be able to interpret the free cash flow for your company for that reason. So that will help you with the first task in computing free cash flow. The second task we see here is related to cash flow from our operating activities to our sales ratio. And the way that we compute that is we take our cash flow, net cash flow from operating activities, and we divide by total sales or your sales revenue. Depends on what your company calls it, but it'll be there. And so with that, I want you to make your calculation. And then I'd also like you to interpret what that calculation means for the company. Now, the cash flow from operating activities to sales ratio is extremely helpful because X, Y, and Z. I want you to explain that. Here we can enter the amount for the cash flow from operating activities. Just below there, we want to enter our sales revenue, and then we can make our computation. So you probably won't use all these cells, but I just wanted to point that out. And then the third task is the cash flow adequacy ratio. The cash flow adequacy ratio helps us to understand the ability to do things like repay our current debt, right? How adequate we are with our cash. And the formula for this is we take our net cash flow from operating activities plus our net cash flow from our investing activities, and then we want to divide that by our short-term debt or current liabilities. And that's going to give us our calculation for our cash flow ratio. And here we can just enter those amounts. So you want to enter your net cash flow for operating activities, net cash flow for investing activities, and your short-term debt amount. Once you have those in, it's just a matter of plugging it into your formula. And then we can interpret accordingly. And that will help you with the Unit 7 template. Are there any questions that you have in regard to completing this template? We're okay? All right. Fair enough. All right. So once you've completed your template, then of course we'll move on to our executive summary. Executive summary, as it implies, I'm looking for you to be able to summarize the work that you've completed in your Excel template. Talk about what it means for the company. I want you to be able to demonstrate your ability to analyze the information. Being able to analyze information is critical for your success in this program. And so that's why I find these executive summaries to be extremely important for you. Then, of course, once you've done those two things, we go ahead and upload those to the classroom. Under the content area, Unit 7, in the assignment section, we have those detailed level of instructions, but of course, in using this, and of course your template that I provided to you, I think this will help to simplify the overall assignment. Any questions, comments, concerns?
Just when your samples, you usually get your executive summaries into 1 to 2 pages.
Yeah.
Some of us, myself included, don't come close to being able to keep it that short. Am
Which,
I making so much extra work for you that I'm punishing you here, or or do you want things to be that level of depth?
yeah, no, it's fine. I actually appreciate the level of detail. For me as a manager, when I ask for that level of detail from my employees, it's something that I feel is critical for me to be able to make decisions about the company. And so, yeah, you're more than welcome to provide as much detail as you like, because it really does help me as a manager to really be able to explain what's going on with the company. Yeah. So yeah, you're more than welcome to
I'll continue to torture both of us.
continue to torture both of us. Yes. And the cool thing with that, Eric, is that as you're composing your final report in the following week, so week 8, you'll be able to parse out a lot of like really great detail from all of your reports that you've done thus far. And so when you're making your comprehensive assignment submission, that's where that is going to come in handy for you. Most definitely. So excellent. Yeah, that's a great question. Anyone else? Any other comments, questions, or concerns? Anything that I could help to address?
Could you speak more towards the cumulative assignment if people
Sure.
want to start working ahead on that?
Yeah, no problem. Absolutely, Melissa. Yeah, it'd be my pleasure. So, if we come over to Unit 8, and Unit 8 assignments. And the cumulative assignment. The cumulative assignment, as the name implies, we're looking for a comprehensive report based on all of the information that you've gathered from your prior submissions. And I've provided a great level of feedback on all of your submissions, and I've helped to guide you toward uh, identifying any improvements that you can make. So if you take the feedback I've provided you in your prior submissions and you take, there's a very large chicken in my driveway right now, it's just setting off the alarm. It's kind of funny. If you gather all of that data from your prior submissions, read through my feedback, make the improvements where necessary, and then with this final cumulative report, we're bringing all of that kind of together in a cohesive way. So the first part is the introduction, talking about the company and the industry that it's in. So a brief overview of the company's business model, essentially, which is very self-explanatory. We see that at the very top of the 10K report. We can also see that, of course, in the investor relations page, etc. So it doesn't have to be terribly long, and this is kind of something you kind of already did way back in week 1. So bringing that type of information in is going to be helpful for you. The second part of that cumulative report is the financial statement analysis. So throughout the past 7 weeks, you've been computing all of these different ratios within your Excel documents. And you've been analyzing those ratios and explaining them throughout your executive summaries. So creating a compilation of that data in a cohesive and understandable way is going to help you in that second part of the final report. And then the third part of that report, of course, is the conclusions, drawing any summaries or findings or insights that you found based off of the company's financial performance, which stems from the performance that you've analyzed over the past 7 weeks. So that type of information is going to be how you will develop your cumulative report. Now, when it comes to the Excel document, this is going to be a very simple compilation of all of your Excel files into one Excel document. And this, of course, is going to I say somewhat loosely, somewhat mirror your financial statement analysis component of your cumulative report. And then we have the third part of this comprehensive, which is the PowerPoint presentation. Now, the great news here is that your PowerPoint presentation that you did, I believe, last week, which I haven't had a chance to look at yet, so I apologize for that. I will get to it as soon as I possibly can. I've started the process of reviewing them. But with respect to your PowerPoint presentation that you completed last week, that's going to now come back into play. So I'm going to be providing you with your feedback on your PowerPoint presentation and your report that you submitted last week. I want you to include the feedback I'm providing to you into a revised PowerPoint presentation, which is going to help you with this final submission. So, of course, it's going to include a couple of pieces of information, the title slide, introduction, the financial statement analysis, which is going to be comprehensive of the ratios and the other calculations that you've made throughout the past 7 weeks. And then, of course, the concluding slide, bringing it all together. Now, as you can see, the format kind of follows what we're doing in the report and with the Excel document. So it all comes together comprehensively, right? So that should be what we're looking for in that final week 8 comprehensive submission. Does that help to answer maybe some questions you might have had, Melissa, that related to this?
Yeah, that definitely painted a clearer picture of what's expected.
Perfect.
Um, Really good to hear to incorporate our feedback from the previous assignments. So
Yeah,
thanks for adding that.
yeah, definitely. Yeah, that's the way that I can visualize your growth through the skills that you're earning through this course based off of your ability to include the feedback I provided to you in all of your prior work. So that's kind of what I'm looking for overall. But yeah, that'll definitely help you for sure. Great. Awesome.
And one more question. For all of these, the deadline still remains Friday and Tuesday. I mean, for
Correct.
for the week 8.
Correct. So on Fridays, that's when your initial discussion board posts are due. And on Tuesday nights, we got the responses to two classmates plus your Excel file and your executive summary for this week. And then for next week, it's a lot more than that, right? Because we got the Friday discussion board post, then on Tuesday, two responses plus the Excel file and executive summary for Unit 8 submission, and then, of course, the report Excel document and presentation for the cumulative. So, uh, to Melissa's earlier point, in the desire to plan and work ahead, I think that would be a very advisable thing to do, especially since there's a lot going on in that final week. But yeah, that's a great question. Awesome. Are there any other comments, questions, or concerns that I can help to address? We're good. Okay, awesome. Very cool. Well, thank you all again so much for your time today. I really do appreciate it. Sorry for this minor adjustment. I was down at KPMG in Washington, D.C., giving a presentation, and I was there all day yesterday. So I appreciate your flexibility in shifting just for this week to today instead of our usual Wednesday. So I appreciate that. But thank you all again. I sincerely appreciate your time today, and I wish you all the best with the rest of your week. And I look forward to our interactions in the discussion board. So thanks again. Appreciate all of you.
Thank you.
Have an awesome day. Thanks so much. Take care. Bye bye.